full house, huh? Amazing. So let's start. Good afternoon. Welcome to the hottest topic of FINANZ'25. And I'm glad so many of you are here and we're going to have full room. That's amazing. My name is Manuela Fröhlich. I'm co-founder of the leading career network, Fondsfrauen, the leading career network for women in asset management and finance in DACH and Luxembourg. I'm very happy to be your moderator for the next 45 minutes. I would kindly ask you to put your cell phones on silent and already think about some questions you can ask us at the end of the panel. Let me start by introducing my high caliber panel here. So first of all, Philippe is the head of regional coverage Switzerland at CACEIS, one of the world's leading asset servicing providers for institutional and corporate clients. Being there over 23 years, he will bring his expertise from the asset servicing angle to the panel. Philippe says, making alternative investments more accessible requires overcoming challenges like education, transparency, and liquidity for investors. Welcome to the panel, Philippe.
Thank you.
And you, if you want to clap, that's okay, I think. Thank you.
Thank you.
All the way from Edinburgh, we welcome Nalaka de Silva, Head of Private Market Solutions at Aberdeen. There he is responsible for developing and implementing diversified investment strategies across the private markets. With this angle, Nalaka has a clear message. Diversification is the best gift you can give to your portfolio. Thank you for joining us today, Nalaka. Ulrich Heuberger is responsible for alternative investment business development at HSBC Asset Management in Frankfurt. His main duties include the positioning of the alternative investment capabilities of HSBC, like private equity, hedge funds, infrastructure, private credit, and natural capital for institutional and wholesale clients. As a distribution expert, he believes it's always good to have alternatives in life. Welcome to the panel, Ulrich.
Thank you. Good support.
Yeah, we're warming up with the applause. I like that. And last but not least, please welcome another distribution and client advisory expert, Wolter, Manager Client Advisory at AQ Investment, part of the German Aquila Capital Group. Henry is responsible for making private markets investment in sustainable infrastructure available to qualified private clients. And he recommends make your portfolio more resilient with infrastructure. Great to have you here, Henry.
Thank you.
So for decades, alternative investments like private equity, private debt, infrastructure, or real estate were an exclusive club, accessible only to institutional investors. But that's changing fast. Today, technology, regulation, and shifting investor demand are tearing down the barriers, making it possible for retail investors to access opportunities once out of reach. The question is, are we truly on the path to democratization, or are new barriers emerging in place of the old ones? Today, we will explore what's driving the shift, the challenges that remain, and what the future holds for alternative investments. So let's dive right into our first question. The democratization of alternative investments is a major industry shift. From your perspective, what is the most significant factor driving this change? Philippe, would you mind to start, please?
So I'm not an asset manager, but I think the most important factor is definitely the alpha and the seek of alpha of the investor. And I think the investor have made the turn of UCITS and all these topics. So seeing the alpha which is coming of this asset class is definitely looked at. And then the second point is definitely the regulatory and political pressure. If you see in the EU, the European Council, so the European governments have made a white paper on the topic to bring a democratization of this type of assets. So definitely the investor and the politics wants to go there.
Thank you. Nalaka, from your angle.
Yeah, I think back to my comment about diversification, I think the capital markets are evolving. And for the last 50, 100 years, we've had a way of accessing the markets. And I think if we think about the type of investment opportunities that are being created, both from growth equity, venture capital, infrastructure, private credit, these are marketplaces that institutional investors have had for the last 20, 25 years. And it's resulted in other parts of the market missing out on these return and diversification benefits. So I think as we've seen equity markets and bond markets become more correlated over the last, 10 years, particularly in shocks. That's been a big shift. And I think the protection aspect of portfolios, being able to have portfolios that are more diversified, that can withstand different economic environments, is part of the momentum shift, wanting to have opportunities that can protect portfolios in a better way, but still provide alpha and growth.
Yeah, great, thank you. Ulrich, what's your take?
I think this is straightforward because it's simply a matter of demand and need to invest in private markets. Given the fact that only a fraction of the industry you can invest in markets is unlisted on a stock exchange, if you really want to invest in the broader economy, in the backbone of Germany, Switzerland, pretty much every market, you have to go private. And this is definitely the place to go to get diversification, to really drive returns, and to invest in innovative areas.
Thank you. Henry, from your angle, what's the significant factor to drive this change?
Yeah, I think the biggest drivers are the bankability and the suitability of new vehicles for private investors. So meaning also in the past, for example, private investor or corporate investor could invest in infrastructure. But the problem was this product wasn't really made for them. So now we see more and more products like the LTIF, for example, which make the asset class just accessible through a suitable product for private clients. And I think this is the biggest driver in this case.
Great. Thank you so much for sharing your perspectives on what's driving this shift. Now let's start to dive into it, how this changing landscape is viewed from an institutional standpoint. Nalaka, how do institutions view the increasing participation of retail investors in private markets, and what impact does this have on overall market dynamics?
Good question. I think as an institutional investor, historically, the introduction of retail investors has been a little bit nervous particularly about the propensity for liquidity, and having been used to having daily dealing funds for many, many years, being locked up in an infrastructure program or private equity or a venture capital program for a decade or longer, I think was one of the concerns about is that capital compatible with each other. I think that softened over time, and I think part of the interesting part about it, when any market democratizes, it creates more liquidity. If there's more transactions happening in the market, there's more sales opportunities, it crystallizes value. So I think, as we've seen, the private equity community, the private capital community, everything from infrastructure funds, all embracing the democratization, building of evergreen funds, being able to attract capital for some of the things that Philippe mentioned. Governments are saying we need to invest, 56 trillion, over the next little while, just in European infrastructure, let alone global infrastructure. That needs to be capitalized somehow. And so trying to incentivize that capital to come through. From the institutional standpoint, we see that as a healthy aspect, but we have to, the point around education, the point around understanding the genuine liquidity risks, the operational risk you're taking with these assets, these are things that institutions are concerned about.
Yeah, thank you. We dig even deeper into that later. So it's clear institutions are adjusting to that. They see the potential in it. Philippe, building on that, what about the regulatory landscape? Are there specific regulatory trends that are either facilitating or hindering the broader access to private markets for retail investors?
For me, there are two elements which are quite important. The first thing, and I will speak about Europe, even if we are in Switzerland, the Swiss know the way to Luxembourg, to Ireland. So when you need to distribute a product broadly European, you go to Luxembourg or Ireland. So the first thing is that the world of funds in Europe today is two worlds. It's UCITS on one hand, coming from 85 back, and now, since a few years, it's IFM is there. So what we bring here is we bring everything together. And of course, Luxembourg and Ireland, which are quite good in terms of marketing and go straight ahead to the point, have created the structure in order to create the LTIF 2.0. And one comment maybe on the LTIF 2.0. Why 2.0? Because the first version, which was created in 2015, was not a success. We see some trends definitely on the LTIF 2.0. The legal structure are there with the ex-KIF and PIF, I like these names in Ireland, and the RIFE in Luxembourg and some other structure are definitely there to help that. But we feel it's coming, but it's not the big boom like we saw with the IFM definitely when it came into force.
Okay, but will there be a boom, or is that something you could already see or feel, or is that too early to access that?
I spoke with one of my friends earlier, and he was mentioning this report of the EU governments, and he said they addressed the point of the fund for the European population. 18% of the European population is familiar to that. Mm-hmm. So you see the way we have to go to make it accessible to the public,
Yeah.
the fund, and then you speak about private markets and you speak about UCITS.
Okay, got it. Thank you so much. Let's move on to the asset classes themselves. Which alternative asset classes are becoming more accessible, and are there particular geographies or markets that are setting the pace? Ulrich.
Well, I'll start with your second question on the regions. Obviously, the US is leading, like in pretty much any ways. The market is broad there, it's deep, it's pretty much established. The bulk of what we currently manage in evergreen assets, 65 billion roughly, is in the US. And that's pretty established. In terms of Europe, France and Italy are leading the way. Germany is number 3. In Europe, the asset base is roughly about 20 billion, growing. We've seen really the market taking off the last couple of years, last 5-6 years. We've seen in the current environment, after the establishment of the regulatory standards of the LTIF 2.0, only 2024, 55 LTIFs have come to the market. In terms of the asset classes, it's pretty diverse. Multi-asset funds, roughly 40%, so really a mixture of various underlyings like infrastructure, private equity, and private credit. Private equity, about 30% of the market, 20% private debt, and infrastructure, 7 to 10%, and real estate, about 3%. The question is really, is there more diversification? Are there more asset classes that we can offer to clients? Yes. What we see in credit is that the market is even shifting to asset-backed securities, CLOs. That's definitely a new trend. The question that you have to ask yourself is really, will the underlying assets qualify for the pickup that an investor demands in terms of the liquidity?
Yeah, we'll cover the liquidity later, yeah. Digital assets?
Excuse me?
Digital assets?
We don't see any demand yet.
Okay. Might be coming also. Henry?
Can I say a word on that?
Huh?
Can I say a word on digital assets?
One word, yeah.
One word.
No, of course, if you can.
I participate, my colleagues know that I like that topic. I like this topic because it's quite new, and I participate in several panels about that topics. And it's interesting when you ask the public, who are the people here in this room who did invest in cryptos? And when you see the hand raising, it's only people who are under 35. So we have a big room to go, but I believe a lot about digital assets, about tokenization of funds, making this kind of product very accessible to the public. Yeah.
Thank you. Coming back to the real assets infrastructure, as a German powerhouse from Aquila Capital, Henry, what's your perspective on which asset classes are becoming more accessible, and also what particular geographies do you see?
Yes. I mean, talking for or representing Aquila, which is an asset manager in the part of infrastructure, sustainable infrastructure, of course, I picked the topic of infrastructure investments. And I think the company grew big with institutional clients within the last decades. But now, for a few years already, we see great demand from also private clients who want to invest more and more in also this asset class, private infrastructure, for example. Especially because I'm talking to wealth managers and banks, these are approaching. But frankly speaking, on the other hand, a lot of private clients and also advisors from the private banking space, they still have their doubts. They're very careful when they make their decisions, because infrastructure is just a new asset class for them. And I think we as an asset manager, we also have to do some educational work on a little bit higher level to convince them and to make them feel comfortable. Second part of your question, where do I see some highlights in the geographies? Coming also back to the LTIF regime, for example, in Germany, it's grown very big within the last years. For example, quoting the scope analysis, fund analysis study, which was carried out this week. We can see, for example, that in Germany, the LTIFs within the last year invested 70% of its volume only in infrastructure. Other countries worth mentioning are Italy and France as one of the biggest countries when it comes to LTIF and structures. And also in Switzerland, we see this trend becoming more and more relevant.
Thank you so much. So while certain asset classes are gaining accessibility, the structures enabling this access is just as important, or are just as important, Philippe. Can you walk us through the most common structures available today in a bit more detail than before, and how they compare in terms of access, liquidity, and regulatory oversight?
But today I will speak first about Luxembourg. The RAIF in Luxembourg is a non-regulated fund. So then the question is, yes, you have the IFM, you can benefit of that structure, but I'm not going to speak about the Lux structure. It's CCAV, contractual fund, FCP, and so on, but the solutions are there. The solutions are there in Luxembourg, the solutions are there in Ireland, if you speak about European distribution, with the Irish having two structures, the qualified investor, IF, and the private investor, IF, so at least you see, we are going already on the trend to make it accessible to investor. In Switzerland, we don't have the structure for that. That's clear. Even with the LQIF, which entered into force on the 1st of March last year, we see probably like 40, 50 LQIF which have been created. But the LQIF is for qualified investors, so we don't have this type of structure. You can by essence use the KG to set up this kind of fund, but it will be not in a fast track process. You will need to have some time to discussion with the FINMA. So the structure are there to create the product. Let's create the product. That's the most difficult part today.
Okay, thank you for the detailed overview, Philippe. Now back to Henry. Considering the structures and asset classes discussed, how do you see the long-term growth of private market investments evolving, and how should they fit into a retail investor's traditional portfolio?
Yep, maybe just to comment on your statement,
sure,
if it's okay, because you mentioned also the LQIF. I think the LQIF orientates itself on the SICAV RAIF for institutional clients, while the LTIF is more tailor-made for private clients, right? And of course, you're totally right. It's difficult to set up an LTIF in Switzerland, but at the same time, I think it's very common for a Swiss investor to invest in a Luxembourg LTIF, for example, from a German asset manager. So this is maybe not the biggest problem from my side. But now coming back to your question, Manuela, hopefully from my point of view, it will play a bigger role in the future of the private markets. But what else can I say today? Frankly speaking, but taking a look at the status quo of the retail investors' portfolio, I would say that private markets or alternatives, or especially infrastructure, only plays in, can only be seen as an add-on, like a satellite strategy. But also taking into account the actual market situations, we see increasing volatility, increasing uncertainty, and what I would recommend is also to add maybe a puzzle piece of a more resilient asset class like infrastructure, for example. And I see this asset class becoming more and more a fixed building block of the portfolio of a private client in the future.
Yeah, well, there's tons of money needed for that, that's for sure. So coming from you as the infrastructure angle, of course, I would recommend, or I would see that you support that. Ulrich, with your broader take on asset classes, what's your take on
Well,
that?
from an asset manager point of view, I also have to say the future is bright for private assets. Is it? Yes, it is, I believe. The market has really taken off in the last couple of years. However, it will be a slow ride and it will be a bumpy ride. Obviously, from an asset manager point of view, we would have hoped that a lot of more assets would have flown into the asset class or into the strategies. However, people are hesitant for a good reason, because we're speaking of a whole new world, new buzzwords, new systematics, whole new features that have nothing to do with what we know, the liquid world, right? So people have to, and this is why you see all of the providers have their universities, their glossaries to make people aware of the various aspects of this whole new world. So it will take time. However, if you take the whole private wealth in the world, it's about 450 trillion. And if we take a 5% allocation, that would mean more than 20 trillion in potential. So that's significant, I would say, for the next couple of years.
It sounds very, very promising. Thank you. With this expected growth in mind, Nalaka, the question of balancing accessibility with investor protection becomes crucial. So how do you see asset managers striking this balance between the accessibility and the investor protection, also given the complexity and risk of alternative investments?
Yeah, I think it goes back to the education point to start with. I think retail investors have been used to a very high liquidity budget. The liquidity budget is, if I need to get out, I can get out tomorrow. So when we, and it's not a new concept. If you had a term deposit that took you for 10 years, you got a better interest rate for the risk you had locking up your money for. So the same principle applies whether it's an infrastructure asset relative to a bond. I'm getting a higher return for my cash flows because I'm holding it for a longer period of time. But at least you get out of your bond portfolio if you needed to get out. It's very difficult to sell a wind farm, a toll road, a hospital in a short period of time. But I think the benefits of holding these types of assets is where you get the diversification benefits. So there are people that will continue to use hospitals and trains and when the markets are fluctuating. And so those cash flows are more regular and reliable. When we're looking at the venture capital space, it's a very different spectrum. So we've had good ideas on a PowerPoint that have turned into billion-pound companies or billion-dollar companies. We've had companies that were a good idea on a PowerPoint that have gone to zero after going up to $1 billion and down to $1 billion from $1 billion. So in managing the investment protections around that, I think it's giving them the tools, and there is a lot of jargon and language, and I describe it like learning padel after playing tennis. Like it's a game. It still have to get the ball across the net, but the four walls create a different dynamic that you have to deal with. The racket's a little bit different, but ultimately you've got to be able to understand the game that you're playing. And I think for the marketplace to genuinely be kind of confident around it, they have to understand the things that they're buying. And we'll talk a little bit about sort of the challenges around that. But I think if I was a retail investor today, I would want to understand kind of the basic terminology about what I'm buying, understand how it reacts in different market conditions. And that transparency, I think, is what will start delivering confidence over time.
Yeah, there's still a lot to do. And you mentioned already the liquidity topic, that people want the liquidity at their hands. It has been a challenge, of course, with real assets. What solutions, Henry, are emerging to address exactly these liquidity issues?
Yeah, thank you for the question. Liquidity is my favorite topic nowadays, I would say, as an infrastructure asset manager. So every week I'm experiencing these questions. What about the liquidity of the assets? And you're totally right, Nalaka, a wind farm is not liquid, right? It's illiquid. But and I would also rather say that liquidity is maybe the biggest challenge we are facing at the moment when we are talking about infrastructure to wealth managers to private bankers. But talking about solutions, I would give you 2 points. First point, very established solution is already the open-ended fund structures called evergreens. So this offers more flexibility to the end investor. So they are not trapped anymore for 10 years or even further. So the investors do not have to deal with long-term durations. But of course, this does not mean that we have daily liquidity. And this leads me to the second point. I'm not sure if the factor liquidity should always be the most important factor. And why is that? I decided maybe to give you a quick insight of my private portfolio. If I have a look at my private portfolio, you would find, for example, stocks, bonds, maybe gold, also crypto investments, and I'm 36.
There you go.
But I'm 36 already, not under 35 anymore. So as a very speculative investment, I would say. But also you could find in my portfolio infrastructure investments, which is very conservative. And what my portfolio does not have to be is it does not have to be 100% liquid every day. But, and as you pointed out, Nalaka, it has to be very well diversified. And well diversified means, for me, different asset classes serving me in different market phases and also helping me in especially tough market phases. So this, for me, is more important than to be 100% liquid every day or every month.
Yeah, great, thank you. Just to understand the audience a bit better, is anyone already using evergreens or investing in, or? 1, 2. The others are hesitant or not showing? Okay, Altif? Okay.
Who wants to invest in Altif? I'll give you my business card later.
Huh? The cryptos, yeah. Anyone in cryptos? See? Look at that. So you have huge potential for all of you to meet everybody at the end, so to
It's
convince
fun.
them.
Everyone is scared about infrastructure because it's just like new to them, but everyone is investing, me too, in crypto. No one really understands maybe the blockchain behind everyone is doing so, but just yeah.
It's the trend. So
Can I make just
Yeah.
a comment about liquidity? We have a
Yeah.
solution in Switzerland which is quite interesting on the
Good.
liquidity
Yeah.
topic. You take the real estate funds in Switzerland, which are distributed to the public. You can, of course, redeem with a 1-year pre-notice of the funds, but you can trade the fund on the stock exchange. And these funds are quoted with a premium because you need to have this premium, which is somehow the risk on the underlying. So it's a fund with a valuation where you can redeem and subscribe if there is a capital increase, and on the other side is quoted on the stock exchange. So there are definitely many solutions on the market also to close the gap. But at the end, somebody has to take the risk of the volatility.
yeah, absolutely. So the right spot was valuation. Looks like you've known the next question already. So one of the biggest barriers actually blocking the greater retail access to private markets has been the question marks around valuations. How can they be overcome, Nalaka?
Look, it's a good question. I think private market assets, I sort of describe it's like your house. You know what your house is worth, but you're not trying to sell your house every day. But when you do sell your house, you want to know that it's priced appropriately. So I think the valuation dynamics have to become more transparent. So it's very common for a number of portfolios to have exactly the same methodology, but have two different values, depending on which manager you've got or which part of the capital stack you might be invested in, whether it's the equity or the mezzanine debt or there's different valuation metrics. So I think some more standardization around how people think about valuations to make them more comparable over time, and some data points that people can go and refer back to. So real estate is probably the best example of a mature market that has used transaction values to be able to try and give you a sense of what your property is worth in between periods. Most of the private capital assets are managed through some kind of DCF modeling. So discounted cash flows of the expectation of returns, a cost of capital calculation, and all of those have lots of inputs that need to go into that. So a bit more data points for people to get their head around the valuation. But I think just making that more visible to see what assets have been transacted over time, because as we've seen over the probably last 10 years, assets get traded at quite high values, and people are buying future growth. And it's very difficult to value a growth equity company compared to an infrastructure asset or a credit asset. So each of these different elements, I think, require much more scrutiny over how managers deliver that valuation to market and the transparency around that. But once we've seen the transactions take place and those methodologies look a bit more understandable or at least translatable, so if you look at a discounted cash flow from an equities versus how it's trading in the market, you can kind of match up what's growing, earnings growth, debt, capital management, cost of capital. These principles still apply in the private markets. You just need to be able to see what you're getting paid for. Is it the cost of capital? Is it the growth that you're buying? Is it the inflation indexing that's happening with infrastructure? And these are the characteristics that are really valuable for clients. It's just packaged in a different way. So when you're buying a private equity portfolio, you're buying growth. When you're buying infrastructure, you're really just buying inflation, indexation, and cash flows. But they're bounded by the asset. And there'll be some regulatory activity that supports them as well. So you need to understand a few of these different attributes. So when we think about valuations, I think we have to be a much broader, you have to understand what it means for each asset class. And then when you combine that into a portfolio where you might have some infrastructure in your portfolio or some hedge funds or equities, you need to look at your portfolio collectively and say, how much exposure am I getting to growth? Because I'm going to get that from NVIDIA at the same time I'm going to get it from my private equity. So I think the lens in which people look at their portfolios will start changing. Things that are more aligned to outcomes, things that are like growth or income or inflation or preservation. How much am I trying to protect my portfolio, and do I overweight private credit or infrastructure? Or do I go aggressive on growth and get into the next range of AI-generated, tech companies that are going to grow? These are all considerations, I think, that portfolio constructors need to look after on behalf of their clients. But without the information around valuations, it's really hard to do that.
Yeah, thank you so much. So that's one point that you mentioned already, or we mentioned before, is really the investor education, Ulrich. What are the most critical educational gaps investors need to bridge to make those informed decisions?
Well, I think education is one hand, but I would like to point you to something else which I really like, and that's behavioral finance. Behavioral finance states that there are cognitive biases that do influence our decision making, right? Like, that we value losses way more than gains. Hindsight bias that, after an event, we have known it before. And there is also the time discounting, leading us to the way that we value something that's, straight ahead of us way more than something that happens in a year, or even in the case of private equity, which is definitely long-term, 10 years, right? This comes back from days when we were all living in caves in the Stone Age. Of course we have taken, a kilo of meat instantly and could not really imagine that someone would give us 10 kilos in a year. No, we want it immediately. So I think besides the traditional education, the new buzzwords, the jargons, the systematic, we have to overcome these kind of mental biases in our head.
That sounds a lot of work for the industry. Philippe, you mentioned that already in your initial statement also about the education. What's your take on how can we help the investors?
CACEIS made a study a few years ago, many years ago, about the ideal fund. And in the ideal fund, one main topic was about education. So it was done in partnership with PwC. So, and we looked in the EU, what is the level of education of all the countries, of the citizens of every country regarding finance and regarding the fund. The thing interesting is that there is one country which is far ahead of everybody, is Sweden. Sweden is ahead because every Swede has been educated and know what is a fund. Why is that? For a simple reason. The pension fund system in Sweden is a state pension with the AP funds, but every citizen has the right to invest 10% of his allocation, of his pension fund, in the fund that he will select on a platform of the pension. So the Swedes, which are quite clever in what they have done, they have decided to educate the people, the citizen of Sweden, at the place where they will all go. It's not the bar, but it's school. School, at the age of 14, they decided to educate every Swedish citizen to make them understand what is a fund, what is the risk, what is the product, how it's working, and things like that. So these people are educated. So, and if you take the number I gave before, 18% of the population in Europe is familiar with a fund. So we still have a long way to go, but it will, for me, go through education.
Yeah, absolutely.
We were speaking about glossaries, we were speaking about many things. I think education is a key element to go ahead, and that's what the question you receive from your private bank advisors and things like that. You have to educate the whole chain of the people who are selling the product and the people who are buying the product.
And at an early age, as you said, it needs to start way earlier than later. So thank you already for your excellent insights. We've been very, very quick because we wanted this big room to be able to ask questions. So I will now open up the floor for the questions. We have a microphone over there. Please make it short and let me know who you want to address the question to, and go. Oh, wow. I thought it's going to be not too many. Yeah, I thought there's going to be lots of questions because it's really a very, very passionate and hot topic, as I said at the beginning. So I'll start questions the other way around. So we had already who's using the LTIF, who's using the Evergreen Fund, who's invested in private markets or sells private markets products. A few? What are you others doing? All liquid? So let's do the other way around. Who is investing in liquid funds? Or selling in liquid funds? Liquid. So there's a mismatch now. Maybe you just all want to hide and don't tell us what you're exactly doing, because the next question would be, who is a wealth manager, private banking, who is selling products to end clients? Who is an asset manager in the room? There you go. So wouldn't you maybe want from one of these lovely gentlemen over there how they're doing things, what they do, what their best practices is? There we go. First question. You win a prize. I don't know yet what, but we'll figure that out.
Hi. So my question is about creating a bit more assurance for investors if they decide to increase their private market distribution in their portfolios. So what would wealth managers and the industry as a whole do to ensure and increase the transparency and the information available, so when an investor looks at his entire portfolio, he has the same type of insight and intensity between public versus private investments?
I would like to pick it up actually, because information in private markets is way greater than in liquid markets. So you have full access to the board of management, to accounting, to everything, right? So the degree of transparency is way better. So that's why you can, also in a due diligence, when buying a company, you know this company inside out. And this is definitely what we share with investors at the end of the day. So you will have all the insights that we have. Nevertheless, what's important, and if I give you one advice, is this whole topic is about democratization of private assets. Democracy is something that you have to work for, right? You have to, you have to educate yourself, get informed, work for it. And I think work with an established manager in a product that you understand, in an asset class that that you understand, that you feel good about, then I think nothing can go wrong.
If I may add on this,
I was just about to say, as an established manager for that, Andrew.
I totally agree on what Ulrich said, because, for example, if you have a look at private market funds, we offer quarterly, very transparent quarterly reportings. And as you said, you can also have just one-on-ones with the fund managers, with the investment managers. To give another example, if you, for example, invest in stocks, given you not the best example like Credit Suisse, or who maybe remembers Wirecard in the past, yeah? And no one had a look at the balance sheet of UBS, Credit Suisse, Wirecard, or even Allianz, for example. Me neither, to be frankly speaking, to be honest, yeah? But everyone is thinking, I mean, it's transparent to invest in stocks. Nothing against stocks, but the balance sheet of a huge global listed company is not very transparent, I would say. But if you look at private market structures and investing in funds, offering you every third month a very transparent reporting, I think this could assure the transparency, if this answers your question.
I think if I just, sorry.
Go on.
It goes back to my comments around disclosures, around valuations, for example. So I think we have a lot of information. We just don't share it very well. So I think, and because the products aren't there to share it with, because all of our investors are historically institutional, right? And we do, exactly as Ulrich said, we provide them a huge amount of transparency. But you can't go on Bloomberg and you can't look up, all of these private assets and get the same level of information at your fingertips. Nor do I think that you probably should, because some of that information gets translated in a way that isn't, good for the market to a certain extent. So you have to find that balance. And I think in some ways, so Nordea Bank Investment Management wrote a paper recently asking the listed market sector to only report twice a year as opposed to 4 times a year, because all of the energy goes into quarterly earnings and creating very short-term mindsets, whereas we look at things over a 10, 20-year horizon, which is perhaps a bit too long, but we need to converge in the middle. So for investors to provide assurance, I think you need to look at the key attributes of the product you're buying. And if someone offers me a daily liquid infrastructure fund, I would be a bit nervous about. But if someone was offering me, if someone said, I can do quarterly dealing with some rebalancing, but it's dependent on a sale of an asset, and the sale of this particular asset is dependent on 3 things: the valuation at the time, the market dynamics, the cost of capital, and we can show you what that might look like. It's a bit like selling your house at that point in time. You know that it will get sold, but that sale might take 6 months. So when you start thinking about your cash flows and how those cash flows might react with your portfolio, I think you get a much better outcome. And many of these assets that we talked about, because of the nature of private markets, are quite defensive, particularly in this environment, where stock markets are moving up and down, but you're getting steady growth. But if you need your money in a hurry, it's a bit like your term deposit. You can't break it and get out early. So when you use your liquidity budget, I think this is a new topic that will emerge, is when you think about your portfolio in 2 dimensions, which is risk and volatility, the 3rd dimension is your liquidity budget. How much can I put into something that's locked up, that I can generate excess return relative to public? And the strategies that I'm investing in, this marketplace is phenomenal. Like the amount of value that's created in this marketplace is only being shared in a very small section of the marketplace. And I think if we looked at, Facebook and Amazon and these companies that took 2 decades to generate value, the companies that are going public, I think the numbers are now, it takes 14 years from a company to be born to go public. So in that 14-year period, all that value is being contained with a certain amount of buyers. We want to give access to everyone for the next OpenAI, the next NVIDIA, the next, these companies that can be born. And if we think about the technology that's being used in these companies, they will be private for longer. They don't need as much capital. And then you've got the heavy capital infrastructure play or the credit side with all very different dynamics. So I think that's where that transparency for you will be much more helpful when you're building your portfolio. And the assurances come with that better transparency and governance.
Great, thank you. Philippe, you wanted to add something as well?
Yeah, I will give the view of the asset servicing and what is the insurance that a depot bank, for example, a depositor bank has in that regard. The IFM was a directive which had a very bad name, because the first element which came into discussion in the IFM discussion is the depot bank responsibility, the obligation of restitution of the assets of a bank. So the depot bank has the responsibility with the IFM to restitute the assets if they are lost, not for performance reasons, for any issues that can happen, which was the case in the years before with Madoff and this kind of topic. So it gave the responsibility. On liquid assets, not on illiquid assets, you have that responsibility. And it's probably something which is under discussion today in Brussels to be reviewed, and what will be the next level of obligation and responsibility of the actors, the asset manager, the management company, because the management company is often more and more today a third party, and the depot bank in that regard. So definitely there are some topics to come also.
Thank you so much. We have room for one more question. Lady in red, oh my God, tongue break already.
Yes, exactly. My question is about taxes, because also when we talk about democratization and funds, of course, for me as an investor, it's important, how these assets are taxed, because in the end, if that's not attractive enough, right, then I will not invest. And I was wondering how you see the international development in this area, because we see it in crypto assets. It's very important because it can be hindering or fostering, but it would be interesting to have your perspective on it, and if you actually feel it, or if it's a level playing field, or how you see it at the moment.
Well, I picked it up in countries like Italy. LTIFs, for example, have a tax gain, right? It's tax efficient, so that's I think a very good way to to promote these kind of asset classes for people, because at the end of the day, in Europe we have so many ambitions, so many things, infrastructure, Green Deal, so many investments we have to make for the future. This can't be done with by state capital. We have to, we have to take private capital, and we have to encourage private capital to invest in this. Italy has an interesting way. In Germany, at the end of the day, you have to pay taxes on gain, on capital gain, full stop. But there are definitely ways to, to promote these kind of products to make it more, more easy, for people to look at. With such, such advantages.
So solutions will have to surface at some point.
Yeah, I think it happens in two forms, right? I think there's the asset level taxation. So private markets is foreign direct investment in multiple markets. So if I'm investing in China versus Italy or the US, the post-repatriation of capital, so when you take the money back out of that country, is taxed on a particular regime.
Right, or withholding taxes.
So withholding taxes, the US has got every tax under the sun that you need to manage. If you invest in Australia or Japan, you've got similar considerations. So your deal underwriting has to make sure you're getting a net of return back to you as your home country of investment that's comparable with the risk that you're taking. So but tax is manageable from an international standpoint. There's double tax agreements, you just have to manage that as part of the portfolio. I think where it also is important is that the country in which the product is being offered doesn't penalize tax for offering that solution, investing globally or locally in a way that you get a worse outcome. So I think that's where the governments are being a bit more progressive now, trying to introduce tax-friendly wrappers or tax transparent wrappers. So depending on who you are as an investor, if you're a pension fund or a wealth manager, you might be treated slightly differently. But there's that layering that you have to consider.
Yeah, exactly, the funds, right? They are tax transparent or intransparent, and there's no communication yet, or countries don't always agree on the same treatment, right? That was...
I think for certain, like you'll probably know better, but for certain wrappers in certain markets, tax transparency is fairly well written down.
But Switzerland is a very bad example for that, because if you look at the Circular 24 and the way the Circular 24 is applied, for example, to fund of hedge funds, where the way you have to calculate which is the part of revenues, which is the part of capital gains, in order to charge the 35% of the tax in Switzerland. In my point of view, there is room for improvement in that matter. I think that's also the success of Luxembourg markets and Irish markets, because the fiscal windows have been used long time ago, also before the finance came in this country, because it was also in industrial countries where they have already agreements with many countries around the world. When you have a steel factory, biggest European steel factory in Europe at that moment, which was based in Luxembourg, you definitely need to work with many countries, and you have these tax links which are being done. So there is room for improvement. Is that the right time today to see that room for improvement? I'm not sure, if I read the press every day. So, but there is definitely...
We'll take that topic next year, so come again next year. Maybe we know a bit more, because we're running out of time. So I want to wrap up the panel now. Thank you for the questions. So the final question I would like to close the session with is, looking ahead, if you could give one key piece of advice or insight to investors navigating the growing world of alternative investments, what would it be? And I start with Henry.
Yeah, thank you. I mean, overall speaking, I think, sorry, every asset class has its advantages and disadvantages. In the end, no one of us has a crystal ball, I would assume. Maybe today stocks are doing well, maybe tomorrow not anymore. And so the only thing that I would recommend, or I would invite everyone in this room to maybe at least think about having a look at alternative investments, maybe infrastructure as an asset class, because from my point of view, it's always a good idea to add a puzzle piece in your personal portfolio, which makes it more resilient and stabilizes it in especially tough times.
Thanks, Henry. We will just go through Ulrich.
Don't be shy. Look into alternatives as a way to broaden, to diversify your portfolio. Remember, there are two friends on the capital market, only two friends you have. That's time and diversification.
Super, thank you. Nalaka.
Don't be afraid. I think just get started. I think that just, people dipped into crypto and they'll have different experiences. People dip into alternatives and haven't, but if you don't get started, you'll never learn about it. So don't be afraid to get started and hopefully find some people to help you along the way.
Brilliant. Philippe.
Use AI and social networks to educate yourself about private markets. You have a lot of information there. Asset managers were very good in the last 10 years to educate their investor on many aspects of their asset classes capacities and how they deal with that. So go in AI and social networks. You will find a lot of material.
Perfect. Thank you so much for sharing your insights, thank you so much for your interest. I wish you a great rest of the conference today. If you find us fantastic, give us a 5-star rating. If you don't like us, tell me. And I might see you tomorrow at my second panel, The Value of Active Management. It's at 2 p.m. at this room. And also Fondsfrauen has tomorrow a presentation at 1 o'clock in room number 4. So I hope to see you all soon. Thank you so much for your time.